Hey, if you're curious about how you can run a mortgage on a property, figure out the numbers, well, guess what, my friend? You found the right video. Hey, Daniel, cue in the intro, please. Hey, how's it going, friend? Juan Pablo here. So on this video, you're not going to see my face. I know you want to see my face, but I just want to show you some things online. So I'm on my desktop right now. And if you're new to this channel, we typically like to focus on three major pillars to financial freedom, which are personal finance. We cover budgeting, savings, credit repair, and so forth. And we also like to discuss the second pillar, which is funding, having a repeatable source of investment capital. And last, certainly not least, real estate investing, where we focus mainly on multi-units as well as multifamily properties. And again, if you're new, please like and share this video if you find value, as well as subscribe. So that way Google and the algorithm can do its thing and provide you with additional videos to help you along your journey towards becoming financially free. So without further ado, let's dive into the topic. So where I'm at right now, I'm in our share hub. This is inside of our community for our members and for our students and so forth. So I just want to show you a particular resource because I've been getting comments from YouTube about calculating mortgages, right? To see if they happen to buy this property, would it be a good purchase based upon the debt service, the mortgage, and so forth. So I just want to show that with you quickly. So what we're going to do now, we got this page here, which is going to redirect us to another web page with Bankrate. So Bankrate is a good tool to calculate many different things. So to calculate the items up here, credit cards, baking, retirement, a whole bunch of stuff. All right, but that's another topic. So what I want to share with you is how to use the online mortgage calculator, something short and sweet. All right, so let's dive into it. So let's say you're buying a property. Let's say it's an 8-unit for 200K. And you might be saying, what, an 8-unit for 200K? Yes, we find deals like that in our markets for our students. I know perhaps in your market, 200K may be a starter home, right? Or it might be a studio apartment, a studio condo. But in other markets, yes, you can acquire an 8-unit for that price. I remember I acquired a 9-unit for 218,000. And I've also bought a duplex for 355 because I lived in the New York City area. That's where I bought the duplex for 355,000. But I didn't buy a 9-unit out of state for 218. So it's really based upon your market selection, which we cover in the program. But that's another topic. So let's just drop this down to 200. Okay, let's say that's the price there. So real simple. And let's say the down payment that you have to put down, since this is 8 units commercial, you typically have to put a 20% down payment. Okay, so it's not to say that you cannot finance this down payment through other means. But let's say for the focus of the mortgage, we're going to put 20% down payment. Okay, so of course you can do seller financing, other forms of credit financing, but for this, we're going to have a 20% down payment because most commercial mortgage lenders require that, or even more. Some might have, it's called LTV, loan to value. Some might have a 75% loan to value, meaning they'll lend 75% of the purchase price, but you got to bring 25% down payment to the table. Okay, so this one is an 80% LTV, which means we don't have to bring a 20% down payment to the table. So you always want to reach out to your mortgage lender to find out how much down payments require as a percentage. Okay, but let's say it's 20%. That's pretty standard. Now the length of the loan. Now if we're doing a commercial property, that's typically 20 years. It's very rare for a commercial mortgage lender to provide you with a mortgage for 30 years or higher. And that's called amortization, meaning the time it takes to pay off the mortgage. Typically, they do 20 years or less, not 30 years. If you find one, that's rare. And if so, let me know so I can reach out to that lender as well. But let's say 20 years on average. And the interest rate, of course, this varies based upon what market you're in, as well as what's going on with the T-bills and all that stuff. So let's say at the time it's recording, because everything changes, let's say it's at 5%, 5% interest rate. Okay. So you see here, if you're buying, even if it's a home, single family, just disregard that. But let's say you're buying a 8-unit for this purchase price here, 200,595 with a 20% down payment, meaning you have to bring 40,000 to the table. Now it doesn't include soft costs or closing costs. It's just strictly down payment. 20 years, 5% interest rate. You see here, your monthly payment will be 1257. Now the 1257, you see how it's calculated here. It has the home insurance, property taxes, HOA fees. So what we want to do is remove this. And the reason why is we want to just focus solely on the mortgage amount. Because when you're analyzing a commercial property, especially if you have a listing, they should give you this information. If not, you could reach out to the deal finder to get those particulars, but they should share with you the insurance, the taxes, and so forth. So what this website is doing is just provide an estimate. So we want to delete that because we want, once we have the listing, we want to put the actual numbers in there. So that's the reason why I put 0. But I just want to show you how to calculate a commercial mortgage, solely just the principal and interest that you'll be paying on a monthly basis. So this is the number you want to use in your cash flow analysis. And we have other video recommendations too, guys. So if you want to know about how to analyze a property or setting up reserves or have a video recommendation, just check the link below to learn more to get access to that video. So we break it down even further. Because I just want to show you particularly a commercial mortgage, but of course, when you're analyzing a commercial property, there's other line items that come into play with the analysis, such as property taxes, insurance, operating expenses, in other words. There's other forms of debt service, such as if you tend to finance this 20% down payment right here, there's 40,000 and so forth. So there's many different things there. So just check out the video below to learn more. The video I recommend. And by the way, if you're interested in learning just additional training of how you can acquire multi-unit properties using OPM, other people money in a more profitable market, because you might be in one of those markets, let's say New York City area, DMV area, New England area. You might be in California, LA, San Francisco, San Diego. You might be in let's say Chicago, Miami, Dallas, Houston, Atlanta. You might be in some markets where either A, the price point of real estate is too expensive, meaning you can't find an 8 unit for 200K, or B, there's not really a ton of multi-units available. You might have a single family duplex or a 200 unit apartment complex. There's no 8 units, 10 units, 20 units, and so forth. If so, then this free training will help you a ton. Just check the link below in the description to learn more. All right, guys, so that was just a short and sweet video. As always, this is to your success. Continue to earn passively, live passionately. Peace.